Uh, the subject today is broad. It speaks about moving towards, or the possibility of moving towards democratic banking. And I suppose it would be useful for us then, or at least for me, to place before you the way I would perceive what constitutes a democratic banking framework, a framework which in some sense reflects the needs and the will of the people. There is obviously enough evidence to show that not just in India but across the world, in most capitalist countries, it was different, of course, in the centrally planned or socialist economies when they existed, that in the capitalist economies, the core of the financial sector, the centerpiece of the financial sector was, and even today, after years of financial diversification and innovation, banking remains the centerpiece of the financial structure. Banking, of course, is a particularly unique animal, as all of you all know better than me, because of the fact that it is, by virtue of being the depository institution, which with two kinds of guarantees from the state. First, a guarantee from the central bank that it will serve as a lender of last resort. That is, if ever there is a problem with liquidity in the banking system, central banks across the world, as happened, for example, in the United States after the 2008 crisis, move into the system and infuse liquidity in order to keep the banks alive. So there is a guarantee to depositors who are going and putting their savings in the banks that while there could be occasional failures of individual banks, in the long run, the basic tendency would be for the state through the central bank, through its operations as a lender of last resort, of providing liquidity in times of difficulty, ensure that the banking system does not collapse in any significant measure. And this is what happened, even though most banks had speculated themselves into deep trouble in 2007. By 2007, we saw that in the United States, the Federal Reserve, in the United Kingdom, the Bank of England, in Europe, the European Central Bank, all of them came to rescue different segments of the financial sector in order to ensure that there is no systemic collapse of the banking industry. The second element of sort of state guarantee is, of course, the fact that in most countries, as happened in India in 1961, in most countries, and of course in India it happened in particular because of the collapse of the Palai Central Bank, which was a large bank. Two banks collapsed at that point of time, Lakshmi Bank and Palai Central Bank, and that really led up to the implementation of a deposit guarantee scheme. So there is always deposit insurance in most capitalist economies, so that depositors are told that up to a certain level, whatever it may be, $100,000, 100,000 rupees, whatever it may be, that up to a certain level, there would be an insurance of deposits, so that even if an individual bank tends to fail, you would find a situation in which the depositor is not actually deprived of the savings that he or she has put into the banking system. So given this kind of a guarantee and the fact that there is a certain degree of regulation which goes with the guarantee which the central bank provides as a lender of last resort and the guarantee which the deposit insurance corporations of one kind or another provide, banks became the first port of call of the nation's savings. In most nations, household savings constitute, even though each individual household may not save so much, excepting of course for the richer households, that banks become the first port of call of the nation's savings. Now, if banks are the first port of call of the nation's savings, to which people put their money very often at zero or very low rates of interest, but do it because of the fact that they find these locations of their savings as being locations which are liquid. They can go and access their cash without much difficulty as and when they need it, including in periods of emergency. That there is a low level of income or capital risk. They would get their interest payments and get their capital when they need it, either at maturity or even before that. And because of the fact that there exists a certain degree of short-termism, that they are in a position to be able to access it at call, that you find that there is a substantial degree of flow of the nation's savings to the banking system. Now, however, if the banking system becomes the port of call of the nation's savings, but receives its money in terms of deposits from people who want a high degree of liquidity, who don't want long maturities but want shorter maturities, who don't want too much risk, then obviously there are limits to which the banking system can use these resources, and therefore it must be put within a regulatory framework. And this was not a phenomenon which applied only in India, it was something which applied in most countries. In fact, we know that between 1930 and 32 in the United States, before the Great Depression, something like 20% of all the banks in the United States, which was close to 5,000 banks, shut down, had to close because of banking crisis. Roosevelt, who came to power, had to declare a bank holiday, and at that point of time, we had the imposition of what was called, or the passing of what was called the Glass-Steagall Act, which actually put a very strong regulatory framework, because it realized that there is a danger of the possibility of fragility which can threaten depositor savings. But the point is, it's not only because of the fact that you want to save depositors' savings that you need a regulatory framework. You also need a regulatory framework because there are two features of the banking system which are quite crucial. First, of course, the banking system, which is the core of the financial structure, is also the core of the payments and settlement system. In modern capitalist economies, people don't carry baskets or bags of currency to the market in order to engage in their transactions. Transactions actually are undertaken through non-money means, in which the principal payments and settlement system or the principal conduits are the banks themselves. So banking constitutes the feature of a capitalist economy which lubricates its functioning, which eases transactions, which makes it possible with low transaction costs for capitalism to function. So if it so happens that there is a banking crisis, there would be a crisis of the payments and settlement system, and if there's a crisis in the payments and settlement system, obviously you will end up with a situation where the functioning of capitalism would get severely affected. You can have a recession, you can have a depression, a crisis of the kind that we've seen periodically. The second, of course, is that banks constitute the central credit pipe in a capitalist economy. So if they constitute a central credit pipe in an economy in which, because as we know, most transactions are sequential. A farmer cultivating a piece of land has to go through a period during which he pays for his seed, he pays for his workers, for his fertilizer, etc., etc. It takes a certain period, a period of production before his output comes, at which point of time he goes and sells the crop in the market. But meanwhile, he's made these payments. He's made these payments to input suppliers, he's made these payments to workers, etc. So transactions in some sense which lead up to productive activity or production are transactions which are sequential, and therefore underlying the whole system where you have that kind of sequential transactions to sustain production is a certain degree of borrowing and lending. The credit pipe is crucial to the functioning of the productive mechanism. And the core of the credit pipe under capitalism are the banks. So if banks are crucial because they constitute the core of the payments and settlement system, which is necessary for the market mechanism to function, if banks constitute the core of the credit system, they constitute the principal credit pipe which is required for the production mechanism to work, then obviously you can ill afford a banking crisis, because that would very quickly spill over, have ripple effects which will undermine the functioning of the real economy itself. So therefore, we have this unusual situation where you need to regulate the banking system, not merely because of the fact that it actually is the first port of call of a nation's savings, which results in a situation in which to protect depositors, you need to regulate the system. We also have the difficulty that because it constitutes the core of the payments and settlement system and is the principal credit pipe, it has to be regulated. Now, when you regulate this system, there is one feature that we need to take into consideration, because if this is the set of institutions, or this is the system to which much of the nation's savings flow, then obviously banks become crucial in allocating these savings to different kinds of activities requiring investment. That is, at all points of time, there exist some people who have an excess of incomes over expenditures and therefore save. There are others who are undertaking investments, which means that their expenditures are more than their current incomes because they expect to get a profile of incomes in future. So banks become crucial in actually moving funds from savers who have an excess of income over expenditures to investors who currently have an excess of expenditures relative to their current incomes. So depending upon where these savings get channeled to, in which directions they move, the whole structure of investment and production in the economy would get determined. So in some sense, what you're saying is that the path the economy takes gets influenced by a banking system, which therefore has to be regulated, not only because it has to be stable in order to make capitalism functional, but it needs to be regulated in order to ensure that the savings flows to sectors which are positive from the point of view of the social system as a whole, from society as a whole. So given this kind of a requirement which is set for the banking system, we basically say that there are a certain set of objectives which banking systems implicitly or explicitly are expected to serve. The first of these, of course, is that the banking system must serve the objective of growth. Any country, particularly poorer developing countries, need to ensure that there is an adequate amount of savings which flow to investments which increase productivity and raise per capita incomes, such that over a period of time there exists adequate surpluses to improve livelihoods as well as to expand the economy and improve welfare. So we first need a system which promotes the interests or serves the interests of growth. The second, of course, is that we must make sure that this growth is broad-based. It cannot be the case that all of the savings, let us say, go to the big monopoly houses or to the industrial sector alone. It cannot be the case that, industry and services take much of the credit, but the agricultural sector does not get most of the adequate share of the advances made by the banking system, which has control over a large part of the nation's savings. And we do know that actually, if you look at the historical evidence, at the time of independence, for example, just 2% of total advances from the scheduled commercial banking system went to agriculture. So you really need to have a form of regulation, a kind of intervention by the regulator and the state, which ensures that the growth is broad-based, that credit flows also to sectors which account for a significant share of national income and employment and is not restricted to a few sectors. So we need growth which is broad-based. But being broad-based alone is not enough. It's not enough that, okay, there is credit which goes in sort of reasonable measure to agriculture, to industry, to trade, etc. But it also is necessary that within each of these sectors and within the population at large, that the system is inclusive. It is inclusive not merely in the sense like the new policy announced by the Prime Minister, the new program announced by the Prime Minister. It should not be inclusive only, that is positive as well. It should not be inclusive only in the sense that you go out there to mobilize savings from people, that it offers financial services to mobilize savings. It must be also inclusive in the sense that credit flows to people at different stages or levels of the sort of hierarchy of inequality. It must not only go to big industry, it must go to small and medium industry. It must not only go to large farmers, it must go to small and marginal farmers and agricultural laborers. It should not only go to rich individuals, it should go to some middle class and poor individuals as well. So you need a certain degree of inclusivity. So you need the banking system to be growth oriented. That growth, it must try and make sure is broad-based in terms of credit delivery. That broad-based growth must be inclusive in terms of trying to bring in relatively lower income or people or segments which are less endowed within each of these sectors. And finally, the banking system must meet the problems which we started with when we thought of regulation. It must be stable. You should not actually have a system which promotes growth, which is broad-based and inclusive, but which is unstable. Take the case of the United States, for example. One of the objectives which the banking system, ever since 1934, was expected to serve was to serve the objective of trying to promote home ownership in the United States. So, in fact, there existed almost a parallel system of thrift banks, thrift units, which actually, what were called the savings and loans banks, which actually were geared to providing credit to promote home ownership. And this was seen as a part of the democratic structure of the American financial system and banking system in particular. But we know that this can get out of hand. What we saw during the period of the 1990s and the 2000s is that in the effort to increase the volume of credit which can be pushed into the system, in order to be able to create credit assets, which were then bundled into securities by the bank and then sold off to investors like pension funds and insurance companies, what began to happen is that without taking into consideration the possibility in terms of having income levels to repay the interest and amortization due on your home mortgages, there was a huge expansion in housing credit. This resulted in an increase in the share of subprime credit from 5% to 20%. And then what we had is, of course, a situation when, at a point of time when we had the subprime crisis. Now, if you look at it only in terms of the fact that the subprime crisis came out of a set of loans which went to help people buy houses, it looks very democratic. But when the crisis came, because this kind of a policy was pursued without taking into consideration the need to create the jobs and the livelihood so that people can pay back their interest and amortization commitments, you had a crisis which resulted in a situation where not only that homeowners lost their homes, that they were thrown out of their homes because they couldn't repay, but you actually were caught in a situation in which they lost their employment. Recession resulted in a significant and huge increase in unemployment, so that the instability of the banking system, even when it was ostensibly being democratic, resulted in a situation where you had a crisis which worked against what seemed to be its own sort of democratic motivation, the motivation of providing people with housing. So it's this set of things which I think we can take together as being something which constitutes the basis of a democratic banking framework. That is, it must be a banking framework which is able to channel credit in directions which ensures that the investments needed to sustain increases in productivity and per capita income can occur, growth can occur. It must channel those savings to investments which ensure that that growth is broad-based. It shouldn't restrict credit access to a few sectors. It should do this in a fashion in which in each of these sectors there is a degree of inclusivity, not only in terms of reaching financial services to a large part of or a majority or an overwhelming majority of the population, but of reaching credit to segments which are at the lower ends in the income and asset distribution hierarchy. And finally, of course, it must do all of this without creating the instability which will rock the financial system, undermine its position as the core of the payments and settlement system, undermine its position as the central credit pipe, and therefore create a crisis which finally affects those who are poor, those who are at the lower rungs of employment, and actually results in a situation where any effort to try and be inclusive actually gets undermined because of the unemployment and the deprivation it results in. Now, if you look at it in this sense, we do know that in some sense we can look at the history of Indian banking, and I'll be very brief, I'm not going to give you a long history, but if we look at the history of Indian banking, it actually can be visualized as a process which was a battle for control over finance in order to make it democratic. We do know that the modern financial system as we know it was something which was brought to India by the British. It came initially in the form of the presidency banks, which of course served the interests of the British administration as well as of British capital. It came in the form of insurance, which was principally insurance which was aimed at ensuring that colonial trade could be insured. The shipping, the sort of exports and imports which are occurring could be insured. Other activities which British business could engage in was being insured. And you had therefore the central part of the modern financial system, which was created from around, let us say, the early 1800s, but particularly after the mid-19th century, was something which served the interests of the British administration and British capital. And really, it was only in the last quarter of the 19th century, and of course,